Hi everyone, welcome to my channel FRM Unplugged. As mentioned or as committed last time, I am back with the second in the series, in the case study series of FRM. So as we mentioned last time also, these case studies will usually form a part of either FRM part 1 or part 2. The case study that we covered last time was usually, it can come in part 1 or part 2, but primarily it comes in part 1. And the case study that we are going to discuss today is the case of Silicon Valley Bank. So there is a basic difference between this case and the last case. The last use case of metallization happened around 3 decades back, but this case study of Silicon Valley Bank, this just happened a couple of years back in March 2023. So this is a pretty new case, and as we will see that such a huge and very robust bank which was 4 decades old. Okay, it's not so much old compared to CT or an HSBC, but 40 years age of a bank is, you can collapse like a pack of cards. That's the main agenda, that we will try to find out the reasons, and as we will see some very basic misses, overlooking or maybe over ambitiousness of the bank management actually led to their undoing. So apparently, to a layman, or not to a layman, maybe to a normal banker, it appears that how can such a big bank ever come down? So it's like a mystery for most of us. So I thought of naming it the Boscombe Valley Mystery, after a story by Arthur Conan Doyle featuring Sherlock Holmes. So we'll just straight away dive into this case. Now, Silicon Valley Bank was formed around 4 decades back. It was having a pretty mediocre or maybe a pedestrian kind of a growth all this while. Their actual moment of glory under the sun came only with Corona, unfortunately. So, like COVID had brought misfortune to many of the banks or to many businesses, but in this case, we find that COVID actually helped this bank to grow much faster. So this bank, if we look at the name Silicon Valley, so it's basically, it caters to the technology-based companies, the companies which are startups, or maybe the companies which are there for the last 8-10 years, which have secured venture capitalist funding. So it was basically catering to those clientele, though they were catering to the clients across the United States, but mostly they were centered around the state of California, where most of the tech startups are located. So from 1983 onwards, it was a normal progression, and then in 2021, when that was the time actually large amount of deposits started coming in, so much so that the bank was at a loss as in not a profit and loss, but they were unable to figure out what to do with that money. So they did what a banker or what a reasonably cautious banker would usually do. They parked the money in a very stable, less risky, but less return generating bonds. And in a decreasing rate regime, locking up funds in long-term bonds is the most sensible thing to do. By default, any banker worth his or her salt would opt for this strategy, and which they actually did. Unfortunately, things didn't pan out the way they had thought about it. We'll come to it once we progress more into the case. Now, this is the timelines. So, like in 83 it was born, but actually from the inception period till 2020, they were, and particularly during the pandemic period from 2019 to 2022, it witnessed major growth, which was not experienced by even big Wall Street bankers like Bank of America, Citibank, and the likes. So, and then it so 2019 to 22 they got very large deposits and which they parked in long-term bonds basically, and then disaster struck. So disaster did not strike the bank directly. The tech sector witnessed a tornado. Tornado as in the venture capitalists were no longer willing to put their funds or to fund the startups, and that easy money, so to speak, dried up. Consequently, these guys, the customers, they had to put their hands on their bank deposits, which is they started withdrawing money. Now, till this point, which is till 2022, it was still manageable. Now, the customers started withdrawing funds, but it was not a run, so to speak. So, but mostly the customers were withdrawing on a regular basis. Now, what happened was this bank did not have much cash on its balance sheet. So, eventually, what it did was to fund the customer withdrawals. The next option which they had, or rather, they did not have any other option but to sell those long-term bonds. And they incurred a loss in selling those long-term bonds. And their CEO made a statement to the press saying they incurred a loss of around 1.7 or 1.8 billion dollar on a $21 billion bond sale. And this further aggravated the situation because the clientele of this bank was very niche, and the bank had a super concentration. It was anything but diversified. It was not a diversified portfolio at all, and all these customers were interconnected. So as it is, they were not feeling comfortable with the way their businesses were progressing, and add to that, they got the news that the bank had incurred a loss out of selling bonds. See, around $21 billion and $2 billion, let's say for the sake of our discussion, $2 billion is the loss. So for a reasonably secured investment like a bond, you are incurring 10% loss in selling, which essentially means something is wrong somewhere. So these customers, they kind of understood it, and they, as it is, they were withdrawing due to the venture capitalist funding dried up. So they further started withdrawing money, and then the Silicon Valley Bank, to fund those withdrawals, they further tried to sell their bonds, which they again incurred even huge losses. And eventually, at one point, somewhere between 10th March and 12th March, the FDIC stepped in and they took over the bank, and they assured the depositors that, look, no need to panic, your money is safe, we are here. So the entire SBB management was dismissed, and then slowly later on they had probably given First Citizens Bank of US had taken over this bank. So that is a brief timeline of how their smooth ride or their joyride slowly witnessed a maybe air pocket, and then the aeroplane could not navigate those air pockets, and eventually the plane had to crash. And that's what happened on March 10th or 11th, 2023. Now, if we look at how this happened, right? So we have to just look at two basic things. See, there are other risks in the banking. So we will just touch upon the risks which were pertinent to this case of Silicon Valley Bank. One is the liquidity risk, right? So liquidity risk for a bank's balance sheet is the depositor comes and I don't have the money to pay him. So he has a checking account and $100,000, he wants to withdraw, let's say $10,000, and I don't have the money. So that is a liquidity risk. And to monitor this liquidity risk, the regulators have suggested two tools, or not tools basically, these are ratios which can give the regulators or the investors or the customers the comfort that this bank has sufficient liquidity. One is the liquidity coverage ratio, one is the net stable funding ratio. Without going into the details of it, just know that these are basically the amount of high quality liquid assets. So high quality liquid assets means those are easily tradable and sellable, and the bank will not incur losses in selling it, and the bank will use that proceeds from the sale to fund the depositors' withdrawal. So banks are supposed to identify a 30-day stress period and what's the withdrawal in that stress period, and accordingly the bank should keep that much of high quality liquid assets. And this similar is the case with NSFR, which is the net stable funding ratio. Now, coincidentally, these two ratios in US, in other geographies, that's not the case, but in US, only the super large banks are supposed to, at least the regulator is supposed to demand these two ratios from the bank to just verify whether the bank's health is alright. So Silicon Valley Bank till 2017-18 was in the small or medium category, and during this deposit boom, it just moved into the large category. So they were in the transition period, and somehow they were not monitoring this LCR and NSFR. That was not a slip on their part. That was a regulatory requirement which they jolly well followed because it suited them, right? And then the second is the interest rate risk. Interest rate risk is a graver risk than liquidity risk because it basically determines how much of your margin gets wiped out when the rates increase or decrease, and it also determines how much of the bank's net worth gets wiped out depending on the rate fluctuation. So interest rate risk is a very big risk that the banks carry. Now, if we look at interest rate risk, right? So, how the banks will manage this interest risk is basically they can manage this interest rate risk by managing or modifying the portfolio mix. Let's say, usually banks will have assets more than liabilities so that it is a solvent bank. But if the assets are too much large than the liabilities, they can maybe reduce the assets, or if it is in a decreasing interest rate regime, then it will try to increase the liabilities, because in an increasing interest rate regime, if you have the assets more than liabilities, then the bank's net interest margin increases, and it's just the other way around for a rate decrease. So when interest rate decreases, if the bank's liability is more than the assets, then the bank's net interest margin is protected. Just keep in mind that the bank pays interest on liabilities and the bank receives interest on assets. Now, just if we take a look at this example, in this particular example, we have assets of 150 and a liability of 250. And assume that all of these are interest sensitive, which means they have a maturity value. They have a maturity, which is there is a particular time period by which it matures, and they carry some interest rate. Either you have to pay to the customer or risk. So these are called interest sensitive assets or liabilities. Now here in this case, we are seeing the liability is more than the assets. So when rate decreases, the increase in the profit owing to lesser interest payment in liability is more than the losses incurred due to less interest received on the assets. So when rate decreases, I'm just repeating it once more, once the rate decreases, my expense on liabilities reduces by much more than my income from assets. So net my profit increases and my net interest margin, either I maintain the NIM as it is or I increase. So in a rising rate regime, bank will try to reduce the gap, and in a in a rising rate regime, bank will try to reduce the gap and make the assets more than the liabilities. or by making the assets more rate sensitive or the liabilities less rate sensitive. So if you when the interest rate regime is rising, right? So what banks will usually do, just for an example I'm saying, it will shift, let's say, all this while it was sourcing the funds from the overnight repo. So, and it will try to shift the funding source from overnight repo to longer period CDs. So when rate increases, the funding, so when I am increasing the when the interest rate regime is a rising interest rate regime, I will try to have more long-term assets than a short-term asset, because if we look at the yield curve, which is the actually how the interest rate behaves with time. So if we will find that the larger maturity fund has larger interest rates. So the bank will try to give long duration assets in an interest rate, in an increasing rate regime, and it will try to give short term liabilities which it can roll over. So that is one of the reasons how bank can manage their interest rate risk. Then there is another concept of duration. So another tool in the kitty of the bankers is duration. So duration basically means maturity. So a loan of 5 years, let's say $1,000 loan, which is to be given over a 5-year period and at 10%, right? So the tenure of the loan is 5 years, but we will see that the duration is not 5 years. Duration will be somewhat less. So duration is calculated by discounting whatever money that the bank is getting. So bank will get the interest at the end of year 1, 2, 3, 4, and on 5th year the bank will get back the interest as well as the loan principal. Let's say the loan is designed that way. So what we will do is 3 years down the line, 2 years down the line, whatever money I am supposed to get, I will try to find out what is that value as on today, which is the present value, and we will add the weights as the time and the amount. So whatever is the loan interest that we will receive, we will multiply it with the time period. Let's say at the end of the second year I am getting $100. So I will multiply it with 2 and I will discount it to the current value and we will add it. So whatever we add, that will be the maturity of this loan. So in this case, if you see at the year 1, bank is getting 100. So the present value of the year 1 is 90.9. On year 2, we are again year 2 the bank will receive $100 and we will like this is the formula for calculating present value. We will in the denominator we will have 1 plus the interest rate and we will have it to the power of the time period that we are compounding, which is in this case it's 2, and then we will multiply it with 2 because we are time weighing it. We are using times as the weight of these present values, and then for all the 5 years we calculate and this is the amount we get, which is 4169.87, and we divide it by the actual face value of the loan, which is $1,000. So if we divide it, we get around 4.169, which is 4.17. This essentially means that the loan's tenure is 5 years, but the loan's maturity is 4.17 years, which means bank is recovering its money in 4.17 years. Whatever is beyond 4.17 years up to 5 years, that is additional for the bank. So this is the bare minimum bank has to recover. This loan has to survive till 4.17 years for the bank to make money. So how this is used by the bank is bank will find out the duration of the assets. Bank will also find out the duration of the liabilities. If the duration of, and then it will find out the duration gap. If the duration gap is very large, then a small increase in interest rate can wipe away a substantial portion of the bank's net worth. So this is where we will see this. See, in this case, the residential mortgage, commercial loans and treasury securities has $210, right, market value. But the duration is, all the three are separate duration. So duration, the 7.2, 2 and 8 years, this has been calculated by the method I just explained in the previous slide. So assume that the bank has calculated that way the duration, and the bank has got that for residential mortgage 7.2, 2 and 8. So the total duration of the assets we are finding by multiplying by the market value and dividing by the total market value, and we are getting it as 6.47 years. Now, what will the banker do with the 6.47 years? Banker can find out that if the discount rate, let's say the rate that the bank uses to calculate the present value of the future money that the bank will receive, if that rate maybe increases from 2.5 to 3%, then bank needs to find out how much my net worth can decrease, and accordingly, if the net worth decrease is not that much, then the bank need not hedge, because hedging also incurs cost for the bank. So in this case, if we see, if the interest rate changes from 2.5 to 3%, then if we apply the formula of duration to the change in price, then we find out that the interest rate, when it increases from 2.5 to 3%, the value of the asset changes. There is a decrease in asset value to the extent of 6.75 million. So this 210 million will reduce by 6.75 million if the interest rate increases. So bank will use this to find out what they can do. If the net worth erosion is substantial, then these are the options in the table for the bank. It can lengthen the maturity of the liabilities. See, this was an increasing interest rate regime, 2.5 to 3%, which means since assets were more than the liabilities and the duration of assets was more than the duration of the liabilities, then it needs to either increase the duration of the liabilities or increase the amount of liabilities, so that the amount of liabilities multiplied by their duration is almost same as the amount of assets multiplied by its duration. Obviously, increasing liabilities is not a very easy thing for the bank to do, but increasing the duration of the liabilities, bank can do by maybe focusing on more long-term liabilities like 4-year, 2-year CD rather than the normal current or savings account. And if, let's say, the bank is not able to increase the tenure of the liabilities, or you just cannot, at the drop of a hat, you cannot reduce the tenure of the asset or increase the tenure of liability. It's easier said than done. So what banks usually do is, then they have the final weapon at their arsenal, which is the interest rate swaps. So banks are one of the largest users of interest rate swap. Interest rate swap is used to hedge the interest risk in their balance sheet. Interest rate swap is not in our scope for this case study, so we will not cover it in detail here. Now coming back to the balance sheet of the Silicon Valley Bank, I think it looked pretty good. Maybe it bordered on the range of an exciting thing to look at. But if you take a deeper look into it, right, you see that out of $212 billion assets, so this is as on 31st December 22. So if you see, out of $212 billion, around 91 billion and 26, around $120 billion is just invested in bonds. See, these guys were suddenly flooded with money, and they see, Just because I've got money, I can't just distribute money just like that, like loans, right? So, and they did not have that much of an efficiency in loans, so they thought, okay, let us park it in a long-term deposit, which is, in this case, it was a bond. And just keep this in mind: when a bank invests in bond, bank has the option to choose. This is a very big freedom given to the bank, that the bank can try to, let's say, if I have, in this case, let's say this guy had $120 billion in bonds, so they chose $26 billion in AFS and $91 billion in held to maturity. So held to maturity means bank can't sell it before maturity, and held to maturity is not marked to market on a daily basis, and the losses, if any, due to rate fluctuations, you need not book it in the balance sheet. But for AFS, available for sale securities, since you can sell it tomorrow also, you are bound to value it in the current, as per the current market rates, and if there are any losses, you have to show it in your balance sheet. So obviously usually banks will try to park more assets in more bonds. They will try to classify as HTM, and that's what they did here. And additional reason why they probably would have done is they expected interest rates to fall, right? So, and they also expected that the tech sector will continue like this for maybe another 3-4 years. And as we will see, the average duration of their bonds was around 6.5 years. So they just kind of had some calculation in their mind, and they just bought those bonds, and they were like sitting back and relaxing. Now what happened was, they failed to pick up this. Okay, we'll come to the reasons on it, right? So this is where any person would have got some red flags by taking a closer look at the balance sheet. First is about the $117 billion that I just mentioned. So it was more than 50% of the assets. But usually if you see the American banks, there is at least, most of them have 25% of their assets deployed in bonds. Second is, another 97% of the deposits were uninsured, which means they were not subject to insurance from FDIC due to that $250,000 cap. And this uninsured money is like a hot money. So even at the slightest of slightest of headwind, I would say, they will start to panic and money will flow out. So it was not a very stable money, the customers' checking or savings deposits. Those were, so 97% of that was uninsured, right? And like I mentioned, out of this $91 billion bond portfolio which was held to maturity, these were not hedged. Okay, so why it was not hedged? Now, the bond had an average duration of 6.5 years. Now, the bank had a hedge, interest rate swap, to protect the bank against rising interest rates. Now, what this management at SVB thought, they were pretty sure that rates are going to come down. So, if rates come down, the hedges which are there to protect the bank from increasing interest rate, this hedge will limit the profitability of the bank when rates reduce. So they removed that hedge altogether. So whatever hedge was there, they removed it, and the deposits duration would have been how much? 3 months, 6 months, 1 year. Savings and checking, it's like a hot money. And whereas the bond duration was 6.5 years. So the bond duration into the bond value was much more than the liability duration into the liability value, which means they had a huge gap. And just like we mentioned, increasing rate will wipe out the net worth of the bank. That's what happened. And these smart guys had removed that hedge for interest rate rising risk. So they were totally exposed, and they had to actually pay the price for it. And like this, liability base also. Now 90%, I think it is around 90 to 92% of the liabilities were short-term customer deposits, and there was, like we already discussed, they were mainly focused on the tech sector, so they had no, there was no effort to diversify also. So if you look slightly, not even deeply, you don't need to be a forensic expert or a finance professional to figure out that something was amiss. But yes, it was amiss. That's what we are seeing here. Then bank declared in a press conference that they had incurred around $1.8 billion loss on a $21 billion sale, and then this further aggravated the situation, and customers, more they started to withdraw money, more the bank one started to sell the bonds, and finally their losses reached to such an extent that FDIC had to intervene, and then they still wondering how the wildfire started. I thought of relaxing a bit before I start with the wildfire. Actually, what happened was till 22, like I mentioned, it was just party time. The tech sector was flush with funds. The funds was finding its way in the bank. The bank did not do much due diligence or much effort in giving loans. They straight away made a deposit in long-term bonds, and they were getting slow assured returns, and they had removed those interest rate hedges, and life was cool. Then what happened is, mid 22 or late 22, the funding to the VC sector kind of dried up, and obviously money was not so easily available, and these tech companies slowly started withdrawing money more than what they used to, but not to the extent that would set the alarm bells ringing. It was quite manageable, so to speak. Now, the additional whammy came from the inflationary trends in the economy. So, post-COVID, due to a pent-up demand or due to an interplay of myriad factors, the economy had overheated. There was inflationary trends, and the Fed did what any central bank across the world would do. They hiked interest rates, contrary to the management's opinion or management's expectation of rates getting reduced. So once the rates were increased, their entire bond portfolio went for a toss. And remember, the depositors were withdrawing money, and bank was not sitting on a heap of mountain of cash. So they had to resort to selling those bonds, and they started booking losses. So customers were already withdrawing money, and then this bank CEO made a statement to the press that they have lost $1.8 billion in a $21 billion sale. That further triggered the next and the most severe withdrawal from the bank, and most of these customers were interconnected. So in the first place, they themselves were facing headwinds, and they would have guessed that since they were in trouble, probably they had affected the bank, and the bank was also in trouble. So just they decided to withdraw the entire money in a very quick span of time. And how was SVB coping up with this? It was trying to sell further more bonds and incurring even more losses. So once their AFS was fully exhausted, they had to put their hands in the HTM bonds. And the HTM bonds, when you are selling before maturity, there are some additional penalty that you have to pay, and plus the bonds were incurring losses. And then they could hardly sustain for a day or two, and then finally the FDIC had to step in, and the matter ended there. The FDIC assured the customers that your deposit is safe, and subsequently this bank's management went to, I think, First Citizens Bank. So coming to a bit of soul searching as to what happened wrong or what didn't work. Obviously, the management failed big time. They turned a blind eye towards the concentration risk that the bank was having, and they lacked management depth. They were without a CRO for the most part of the stressed phase, and the CRO who was recruited was not sufficiently experienced or skilled to handle such a scenarios. And we would guess that maybe either the people who were doing stress test did not inform the board of the large duration gap they were having, or they didn't run those stress tests which could have gave some clue to the bank as to what could go wrong. Either they did not do the stress test, or they did the stress test but they did not inform the management. And this interest rate, for interest rate risk management, you remember they acted like a greedy cowboy bankers. They just wanted profit at any cost, so they removed the hedges which would have actually, why they removed the hedges, like we discussed, they removed the hedges so that they would not, their profits would not be hurt if the rates declined. But the rates never declined, the rates only increased. So in a nutshell, it was just gross incompetence of the management. And additionally, if you see, this is one of the rare cases which has been the case where the regulators were found not up to the mark. They glossed over certain things and they gave more breathing space to SBB because they were just transitioning from a medium to a large bank. So they did not subject SBB to the same regulatory scrutiny that they would have otherwise done to another bank of similar size, just because this bank was migrating from a medium size to a larger size. And then in the interim, there was an act was passed in US which actually increased the threshold for regulatory scrutiny. So if the threshold was 80 billion and you increase it to $200 billion of asset or whatever, so this bank, SBB, this escaped the regulatory scrutiny. And who knows, maybe if had this bank been under scrutiny, then this kind of red flags would have been picked up quite earlier. We don't know for sure, but that's what we conjecture. And the market conditions obviously had a role to play because the economy was overheated and there was inflationary trends all across the economy, and the central bank, which is the Fed, they hike the rates. So that is all about this SBB case study. This just to recap, this is a pure and simple case of overlooking the basic risk management tenets that we have seen. So that's all for today. And if you found this useful, do consider subscribing, liking or commenting. This would mean a lot to me. And if you have any queries or suggestions, do please write in our comment section. Thank you.